Good morning, everyone. Thanks for being here. I see we still have people logging in, but we are going to get started. Welcome again. Thanks everyone for being here today. My name is Erica Morin, and I am the Manager of Training and Member Services at MSIC. We have a very exciting presentation for you today from MSIC Partners. It's called the Successful Mortgage Strategies for 2022. And with us, we have Jack Caulfield and Jeff Lipes of MSIC Partners, and they're going to discuss the latest trends in mortgage lending, the changes underway in the mortgage industry, and they're going to share more information about MSIC Partners. Just a few quick comments before we begin. We have time left at the end of the presentation for question and answer, but please feel free to ask your questions or make any comments during the presentation, and we'll answer them as we move along. You can send those questions via the chat box or the Q&A that you'll find at the right-hand corner of your screen. Send them in and we will answer them in the order they are received. With us today, again, we have from MSIC Partners, we have President Jack Caulfield and the Senior Vice President of Mortgage Services, Jeff Lipes. But before we dive in with Jack and Jeff, let me first introduce you to President and CEO of MSIC, Mike Hansen, who will be kicking things off today. Mike, the floor is yours.
Thank you, Erica. And thank you, everyone, for joining. Most of you are familiar with MSIC, and I've met most of you. But for those who are new, MSIC is the nation's oldest deposit insurer for credit unions. We were formed 60 years ago, 9 years before there was NCUA insurance. And today we're the fourth largest credit union cooperative in the world. Our 80 credit union members and MSIC hold over $30 billion in total assets. And MSIC has the highest capital ratio and coverage ratio of any deposit insurer in the nation. We insure over $2 billion in excess shares and deposits for consumers and businesses at our member credit unions. Now, 12 years ago, MSIC, we do a lot of other things for our members and our active risk management program, and we provide a whole bunch of management-related services to help them thrive because our deposit insurance risk is low when our members thrive and succeed. One of those things is this, MSIC Partners. We started 12 years ago because we saw the need for a collaborative effort in mortgage lending. So let's talk about why MSIC did that and where we are today with MSIC Partners, which so far is a tremendous success. This has not been done in any other part of the country, and we have a very big group of investor credit unions, and we've built a great infrastructure to make mortgage lending more profitable for credit unions who we do business with. Now, first, the benefits of mortgage activities as part of a successful credit union strategy is obvious. All of you know the financial benefits of mortgage lending if done properly. But also, we must remember that there's no better way to tie a member to your institution than through their mortgage loan. And long-term membership growth, successful membership growth, profitable membership growth, in many cases is tied to a successful mortgage operation. So there are lots of great benefits. But there are varying types and sizes of credit unions out there. There are those that don't have the ability, because of the cost of mortgage lending, to have a full mortgage operation. There are those in the middle range asset size that are trying to do mortgage lending, but have a great deal of headwinds over the cost of doing it properly. And there are large credit unions that have a full mortgage operation, but even they struggle to make sure that the mortgage operation is both profitable and effective. And the reason is the cost. Those of you who are doing mortgage lending now, take a few minutes after this presentation and evaluate the cost of your mortgage operation. Very few people have a real concept of how much it costs you to put a mortgage on your books or to sell it in the secondary market. When you look at the infrastructure that's necessary, the number of people, the originators, the processors, the underwriters, the time of senior management. It is really a difficult process to do. And of course, the trick on whether it's profitable or not is volume. The problem with volume is we have good times and bad times. And when volume is down, your costs skyrocket. And so it's a very volatile situation. And only the largest credit unions with a steady stream of volume in this market are really able to do it consistently on a profitable basis. But when you add up all the time, all the costs, you're going to be surprised at how difficult and costly it is to put a mortgage out there based upon your average volume. And don't forget compliance. Mortgage compliance is mind-numbing in its complexity. It's getting worse. And of course, there's the cost of that compliance and the cost if there's a compliance failure. The problem becomes that the compliance aspect of this is many times a hidden cost that drives up the cost of your operations. So how do we fix this? How do we help credit unions get into the mortgage game, improve the profitability of their mortgage operations, and find an ability to do this that will weather both good times and bad in terms of mortgage volume? Well, 12 years ago, the MSIC board and I decided we needed a platform for collaboration where credit unions can share costs and compliance burden over a wider platform with volume coming in from multiple institutions and building an organization with real expertise that can handle the complexities and the compliance burdens, helping our CEOs get in the game without having the burden of the costs and the difficulty to establish a profitable mortgage operation. You then can turn your resources to gaining those new members and offering mortgage products without having first to create a massive infrastructure that allows you to do it profitably. And there's really no need to develop a full mortgage infrastructure if you can outsource through a reputable and effective partner. You have to have some mortgage infrastructure, of course, because you still have to underwrite and make decisions, but you're not burdened with the day-to-day aspects of putting mortgages together. You can lower your costs significantly, and you'll find that out if you do that exercise I mentioned at the beginning. Evaluate your full cost of a mortgage going on your books, and you're going to find that by doing it through a collaborative platform like MSIC Partners, you're going to lower your costs, and you're going to be able to free up your time and your team's time to do the productive things of developing your membership base and also offering other loan products while getting in the mortgage game and continuing to offer them these products. So today, we've built that infrastructure. Partners is up and running. It's doing a very effective job. And I want to let Jack Caulfield and Jeff Leipz tell you about this and go over the ways in which you can lower your costs and improve your effectiveness. And if you're not in the mortgage game yet, really get in the mortgage game in a profitable basis. So I'll be around to answer questions at the end if anybody has any, but right now I'll turn it over to Jack.
Thanks, Mike. Let me just turn that over to you, Jack. And you all set, Jack?
Yeah.
Yep. You just share
I
your
just have to click share.
Great.
There we go. Let's hit one more button. Good morning, everyone. Mike, thanks for that introduction and the support of MSIC. It means a lot to have somebody like MSIC behind us and under your leadership. I'd like to welcome all the 25 credit unions for joining us, and a special shout out to Erica Morin for coordinating this webinar, getting everything together in advance and getting so many folks on the line today. So with that, let me start. Just quick introductions. These are it's almost our yearbook photos, but you know, pre-Medicare yearbook photos. First, Jeff Lipes. Jeff joined us in October of 2019. He is a very experienced mortgage banker. He's worked for credit unions, banks, mortgage companies, companies and banks of different sizes, in different places in New England and out in the Midwest. Jeff has started mortgage companies. He's sold mortgage companies, and we're lucky to have him. He's the mortgage expert on staff. I am a longtime veteran of the Massachusetts banking and credit union industries. I previously served as the CEO of Leominster Credit Union for 15 years, and then also 5 years at St. Mary's Credit Union in Marlborough in a similar role. So we are very happy to be with you today, and look forward to sharing some information about us as well as the mortgage industry, and fielding some questions. As Erica noted, we want to make this interactive. If you have a question, send it along to her, and she'll vet them and then put them forward to us at the appropriate time. Jeff and I got to share narrator duties. I'll just kick off with kind of an environmental overview, and we'll take it from there. So this is just a quick outline. We'll look at some mortgage industry trends, what's happened over the past year and a half. 2020 was very interesting, and 2021, we're 3/4 of the way through it. We'll look at some forecasts related to the mortgage industry for next year. When we're developing some slides and thinking about specific mortgage strategies and where this presentation would go, we realized that a lot of credit unions will be on the line doing mortgages very differently. Jeff's going to take this bullet point, and he's going to speak at a very high level about mortgage strategies, and we'll kind of let the audience steer us based on your questions or comments. We will have some additional slides in the slide deck when you get it. We're not going to review all of them in this session because some of them are kind of geared more towards very basic strategies, and we just wanted to kind of be a little more all-encompassing for those on the line. It might be unusual to have the commercial in the middle, the About MSIC Partners. That's done for two reasons. Number one, we wanted to share what we're all about, but we also wanted to provide some perspective when Jeff talks about some case studies of how collaboration has worked with some credit unions that have used our services. With all of his years of experience, Jeff has some great efficiency tips that we hope that will help some of you on the call today, and then we look forward to your questions and answers. So that's our overview. Just getting ready for trends. I'll look at the history of mortgage rates, some mortgage volume data, the housing market, and then of course some Q4 forecasts. The initial slide here is kind of what this may be known by most of you, but this is where mortgage rates have been since January of last year. So back in January of 2020, when we're all hearing about this strange virus that's starting to make its way across the world, mortgage rates were around 3.75, and then we all headed out the door probably around March. We saw a minor rate spike, but then pretty much a downward trend in rates with historic lows. I think there were either 13 or 14 historic mortgage lows reached, and the all-time low was in January of this year at 2.65. Rates started to creep up, but as you can see by the high noted at 3.18 right here, that was just an April Fool's joke or whatever, and then they kind of have climbed back down and stayed under 3 since then. This is just a projection from Freddie Mac for the final quarter of this year. So this is another slide of mortgage rates. I got this off of a website that Optimal Blue provides. Optimal Blue provides pricing engines for loan origination systems. And this was an interesting slide. This just shows the last year. So we're So I think I pulled this off back in earlier this month. It shows by product. So the 30-year conforming is in the darker blue, not quite navy, but kind of shows the trends, and this reflects what we just saw in the other slide. The rest are either jumbo or government programs. This, for example, is the VA, the kind of the purple line. And then the line at the bottom is the 15-year conforming product. What I notice when I see this is just how the gap has widened a little bit, kind of showing the, in maybe some economic uncertainty, there's usually a flight to quality. So certainly those are products that a lot of you are originating and you may be retaining in your portfolio. These are just the forecasts through the end of the year from different housing authorities. What I see, which is most interesting, is Fannie Mae is at the low end and Freddie Mac's at the high end with 50 basis points separating them. Everyone else seems to be in the middle. I think we're like around 2.29 right now, so not too much change. But some of the experts or the large players in the industry are predicting a bit of a bump before the end of the year. My apologies for what looks like a very busy slide, and it is. This is again a Freddie Mac slide, an economic forecast from them. We start in 2020 and go all the way out to forecast in 2022. What I would say is the first line is just a survey of mortgage interest rates. I think it's a quarterly average. Certainly, just as that slide said, we have been on the downward path. And then Freddie Mac, at least, is just predicting a moderate increase in interest rates. Excuse me. Home sales. We had this tremendous growth or great growth in the third quarter of last year, the fourth quarter, kind of all the way through the first quarter of this year, and then we've slowed down. A lot of that is due to inventory problems, as well as construction slowdowns. Things in the supply chain have been impacted and demand has been overwhelming. The third line is housing price growth. And, we were showing quarterly price increases in the 4s and the 3s. So, rather impressive. At least at Freddie Mac, they're predicting more of a return to some more normal, but still moderate increases. I think about 5% on an annualized basis going forward for housing price growth. What might be of more interest is projections for originations. They seem to be showing that they're going to return in 2022 to levels probably where we started back in the first quarter of last year before the pandemic hit, and then things went crazy in the mortgage market. They're showing that the purchase market should remain strong. However, refinances really seem to bottom out quite a bit. If their projections hold true, you're looking at refinance originations at half the level that we were looking at about a year and a half ago. So that I know credit unions and community banks tend to rely on refinances unless they have outside originators or are deeply tied to a lot of real estate professionals in their local community. So this may be of concern to some of us. Just another quick forecast snapshot. Again, that quarterly average of mortgage interest rates, slight bump, be it 50, 60 basis points. Home sales remaining fairly strong, not huge growth, but the housing price growth, where we saw double digits in 2020, and the forecast for 2021 is for even higher. We're back at more moderate levels. 5% is not bad return on our homes, but certainly not at the double-digit level. And then again, the total originations much lower. So I'm going to turn this over to Jeff now. Jeff's going to talk a little bit about, from a high level, some strategic priorities. So again, a lot of these, we have slides that you'll see on the slide deck. may not go into them unless you folks ask us to go into it a little later. But Jeff, you want to
Sure.
take
Thank
it
you,
from
Jack.
there?
Thank you, Jack, and welcome to everybody on the webinar. Thank you for coming in. First item was sort of lessons from the pandemic, and in my mind, there were two big lessons from the pandemic. The first one was how did you keep your talent? What we saw was a lot of banks and private mortgage lenders were paying up for talent, and we saw the credit unions losing some of their experienced staff to people that were paying exorbitant amounts of money to get them to come over during the high volume time. So the pandemic caused what I would call sort of an erosion of good talent at the credit union level. And it flowed over to where the mortgage bankers that sort of concentrate 100% of the time on mortgages. So that caused a number of credit unions with which to try to figure out how to keep up with volume with the talent staff that was less than what they were expecting. The second item or lesson that we learned from the pandemic was really that you need to be digital, you need to be paperless. In March of 2020, when a lot of people sort of went home, how did you handle your business? And if you weren't geared up and you weren't ready to be in a remote work environment and in a digital environment, it made it very, very tough on you and required people to come into the office, sometimes against their will, but they still did come in. But I think it pushed forward a much faster pace of the industry looking to be in more of a digital environment, paperless environment, and to offer some remote working capabilities. So those to me sort of were the two key lessons from the pandemic. So now we talk about 2022 going forward. What products might you need? Obviously, we all know that the typical vanilla 30, 25, 20, 15, 10-year fixed rates are always going to be out there. But some of the other things to just make sure that you may have available would be a portfolio product. A lot of time you use a portfolio product, one for either a first-time home buyer or for a specific type of return that you might want to get that may be higher than what you're doing if you were selling a loan. The other things to consider are maybe some long-term ARMs. It's not a big popular product today, but as rates start to inch up a little bit, 5-year, 5/1 ARMs, 7/1 ARMs, 10/1 ARMs. I even saw one player that has a 15/1 ARM. So that might be something to consider. Jumbo loans, what are you going to do if you're not putting those on portfolio? Just make sure that you have some outlets for those large loan sizes. And then lastly, your government product. Government product can be one, the state housing, whether it's mass housing or MHP1 or FHA, VA, rural housing, things along that nature. So you just may want to look at that. From our standpoint, MSIC Partners supports the mass housing program and the MHP1, and next year we should be ready to do the FHA, VA, and the rural housing. But let's then go to pricing. 2022, many credit unions do not use what they call loan level pricing adjusters. They have a fixed price regardless of the risk of the loan. As all of us know, each borrower brings on a different type of risk criteria. Somebody that has a lower FICO score with a higher loan to value is going to be more risky than somebody that's putting a lot down and has a great FICO score. So you might want to look into making sure that you're getting paid for that risk. And how do you get paid for that risk is making sure you have loan level pricing adjusters that are built in. We recommend that you follow Fannie and Freddie's typical loan level pricing adjusters. One way with which to accomplish that is to use a pricing engine. At MSIC Partners, we have a vendor called Optimal Blue that does pricing and product for you, where you input your rates, and then the Optimal Blue goes and it can go right on your website to where the consumer can fill out their information, and it will come back and tell them the price with all those factors figured in to make sure that you're getting rewarded for the risks that you're taking. The next one being industry relationships. Key ones are Federal Home Loan Bank. If you're not with Federal Home Loan Bank now, you may want to look into that. If you need some hand holding while you're doing that, you can reach out to us and we can give you some guidance of what we've done with some of the others to help try to get their policies and procedures in place to meet the Federal Home Loan Bank. Also, the GSAs, Fannie, Freddie, you want to at least be a partner with one of them. And then as I say, the state housing, mass housing type thing. And then you may even have some sort of a correspondent relationship if you wanted to do VA or FHA. And lastly, it might not be a bad idea to have an industry partner that can do fulfillment like us, like we could. We can talk about talent. Last year, when a lot of people were suffering and losing talent, we were fortunate. We grew from 2 employees to 14 employees. How did we do that? Well, luckily, my years of experience has a fairly large network, and I was able to recruit and bring over a number of people that are very, very experienced mortgage bankers, and they've worked for me in the past. So we've brought to the table a talent pool that can compete against any mortgage player in the country on a fulfillment standpoint. Maybe something that you want to take advantage of, because that's a rarity in the credit union business, where you have somebody a group that has that much mortgage talent. Mortgage fulfillment. I think the question that I would say you want to ask yourself is since TRID came out in 2015, is compliance running your operation, or are you running the operation and compliance is just supporting it? What we have seen historically is that in the last 5 or 6 years, the fear of compliance has made compliance running your back shop. What we think that what we can bring for you is our compliance knowledge to know where we could push back and where we can. We have seen historically the decisions being made that allow you to be a little bit more liberal with things, but still be in compliance. The other issue being a lot of companies have talent that may be over conditioning or under conditioning based on they're not keeping up to date with all the rules of what the pandemic changes were to be able to sell the loan, or what rules changed to be able to reduce documentation to make it easier on your member. Lastly, on that, there's usually a big cost with your loan operating system. You not only do you have to usually license it and pay for it on a monthly basis, but you also have to keep upgrading and making improvements to it. So it can be costly and a good thing to look out and see if there are some other alternatives. So that's sort of what I would say are 2002 priorities. I'll pass it back to Jack, and then after he's done, I'll go and give you some case studies and some efficiency tips.
Great, thanks, Jeff. Just to emphasize the pandemic, things just aren't going to go back to the way that they were. So that's something to keep in mind. And we've all been pushed for remote work and paperless systems. And from there, I think we can help out. So I'll quickly talk about MSIC Partners. Mike Hansen introduced some of what's, some of the history behind it. But we're a partnership of MSIC and 26 Massachusetts member credit unions. We started out with 28. We've lost a couple to mergers, but we have a good base, and some credit unions are new to the QSO concept. We hope this is the beginning of other QSO opportunities moving forward. So again, we're a credit union service organization. We have to primarily serve credit unions or credit union members, and that's what we do. We don't service any banks. Mike Hansen talked about the scale of the MSIC cooperative. Our scale is, and some of these numbers might need to be updated, they're probably only bigger now. We're over $6 billion in total assets when we look at all of our 26 credit unions and over 375,000 consumers. So if just our own members all used us, would be serving quite a large group of consumers, and in Massachusetts. Because we're not a financial institution, we need to be licensed as a mortgage lender. We're also licensed as a mortgage broker. Our staff is also licensed, so we're operating under a little different set of rules. We're still regulated by the Mass Division of Banks, but we are more like a mortgage company than a financial institution. We also have an insurance agency license. We haven't used it too much. We're just in a broker relationship currently to help out some credit unions accessing some required insurance services. As we gain some additional scale on the mortgage side, we'll be doing more with the insurance license. In terms of our strategy, we're a little different than many of the other players that some of you may be working with or have worked with in the past. We're focused first on the fulfillment side, really the mortgage back room. Others may be more geared towards the origination side. We are prepared to do originations and can do those for credit unions now, but we first wanted to make sure we had the best platform, the best people to really take a flexible approach with our credit unions, so that you're a better mortgage lender in the way that you want to lend and conduct mortgage activities. If you've had a presentation from us, you've probably seen this slide. This is just a quick overview of what we do. Jeff came up with more of an Olympic style product description. So bronze is an underwrite only program for a flat charge of $500. We will underwrite to secondary market standards and or your loan policy. We will provide a recommendation to you. In all of our programs, you are not delegating underwriting authority to us. You're still making the final decision, but we will give you a recommendation to approve, deny, to counteroffer. We'll give you detailed conditions, really pretty much writing the commitment letter for you. And then our next, so that's kind of, we've helped out credit unions for a variety of different ways in that. Jeff will give some examples later on. Our silver program is kind of the bread and butter. This is where you, the credit union, take the application from the member, and then you turn it over to us, and from there we will disclose, provide a loan estimate to the mortgage applicant within the required time frame. We process, underwrite, and close. So just like the bronze program, we will provide your credit union with an underwriting recommendation, and when assuming that you say move ahead, then we will continue to process and bring it to close. You will close that loan with your funds in your name, and you'll be able to use your vendors. So again, you maintain a lot of control, and the biggest control you have is you'll still be the primary contact with your member. You'll introduce them to us because we'll want them to sign e-disclosure so they can provide us electronic documents. But again, you're the key contact. We're working in the background. Again, we're kind of producing a commodity here. Our charges are a combination of what the credit union pays, and then a portion is what members pay. The market tends to bear a minimum of 500 applicant origination fee. In some markets, it's a lot more. So in some cases, credit unions are sharing just a portion of that origination fee with us, and then they're retaining the rest. The gold program is where we would originate the loan. We would take the application. So there's a little different fee structure there. And then my little notes in parentheses are that good old FAS 91. Our costs would be used as a yield adjustment for you for accounting purposes over the life of that loan. So, if you sold that loan, you'd have to recognize our costs. If you portfolio that loan, our costs would be deferred and amortized over the life of that loan. So that's a quick overview of our services. A busy slide. I'll just hit on some of the points. Jeff hit some of them. And I just mentioned the first one again. You retain the member relationship while mortgage lending becomes a variable cost. Whether the mortgage market is hot and crazy or whether it's slow and there's no refinance activity and moderate level of home purchases, you're trying to keep your mortgage people busy. So I consider them the fixed cost of an operation, and you're able to outsource that, where you're able to invest in salespeople like mortgage originators, additional loan officers, and the like. Things like QC costs go away, loan origination system costs. The second bullet is Encompass, and just an introduction to Encompass. Some of you may already use Encompass. That's the mortgage loan origination system we use. We acquired a Encompass license from our first credit union client. They had invested quite a bit in making their mortgage operation paperless. They saw the benefits of being all digital. We took that over and we've further enhanced the Encompass to service a multi-institution environment. We invest a lot. We have an individual on staff who's our in-house administrator, and what he does is he works with the mortgage fulfillment staff to eliminate barriers, to make our process efficient, fast, and also of high quality. We can provide a website through Encompass. Jeff mentioned we can also provide a pricing engine. We're committed to having what we think will be an excellent platform, and you can really eliminate a cost. There's other options if you want to stay on your platform. It's not typically ideal for us, but we have worked with credit unions that have wanted to keep their current origination system, and through some other technology magic or sometimes challenges, we're still able to fulfill their loans. The good thing about Silver and Gold, if that loan doesn't close, you don't pay us. We just move forward and wait for the next application. You're able to, regarding quality control and the requirements of the secondary market, including the Federal Home Loan Bank, we will do the quality control on the loans that we fulfill, and we will share those reports with you. Technically, you can't outsource the responsibility for quality control, so you still have to oversee us and possibly audit ours, but that's another cost and can be a significant cost that we can eliminate. So there's other bullets. Jeff touched on some of the compliance and the underwriting, and he'll talk about, we also, for more complicated mortgage applicants, we've invested in some technology to help that process go on. So I think the key to remember, more flexible approach, and you're more in control, especially of that member relationship. Jeff talked about our people. This is just a quick org chart. Pretty much down at the bottom, we're 4 deep at the processor level, 3 deep at underwriting and closing. And we also have a disclosure specialist so that we're on top of those compliance issues from the very start. So that's just a quick introduction. Jeff, I'll turn it back over to you. Jeff's got to look at some case studies and also throw in some efficiency tips.
Thank you, Jack. So what we try to do in this presentation is give you some real life examples, and you may be able to say that could apply to me or my credit union, or that may not. But we figured by doing some case studies, you'd get to see sort of how we've helped. So in this example, we had a small credit union who was active in doing the mortgages, but they were so small that the CEO was doing the underwriting of the loans, and they were trying to get approval by Federal Home Loan Bank, and Federal Home Loan Bank required a separation of duties. So they couldn't get approved by them. So what did they need for a solution? So the solution for this was to come over and join our bronze level, which is underwrite only. So they signed up with us. They now, when they have a loan that needs to be underwritten, they digitally send it to us. We underwrite it and provide it back to them. And then that has met the approval of the Federal Home Loan Bank as being a separation of duty, so that they can move forward with the approval of the Federal Home Loan Bank and know that they had top quality underwriting with somebody that knows all the agency guidelines, putting the conditions on there. So that's case study number one. So now let's talk about sort of what I would call an efficiency tip. I'm going to give you 3 or 4 efficiency tips during this and explain to you why I think it's an efficiency tip. So the question being is, you may want to ask at your credit union is, there's a rule out there that says you have to make a underwriting decision within 30 days of a completed application. So how does your credit union treat that? Most credit unions treat that as the day that it became an application starts the 30 days. And the law says an application only has to have 6 pieces of information, like the name, income, social, property value, and mortgage amount. But it's really not a complete application at that time. So if you start your 30 days from the day it became an application, after it gets disclosed, you may be running around still trying to gather trailing documents from that borrower, whether it be pay stubs, W-2s, divorce decrees, tax returns, whatever. And it may take a while to get that, and all of a sudden it puts pressure on your underwriting team or underwriting department to get that approved quickly because the 30 days is coming up. Well, we follow the position that is clearly written by COA, which says it's a definition of 30 days from a completed application, and the lender gets to define the parameters around the completed application. So if you'll see here on the slide, a COA's definition, it basically means when an application is in connection with a creditor has received all the information that the creditor regularly obtains and considers in evaluating applications. But it's not limited to credit reports and other things along this nature. So from our standpoint, we would recommend as an efficiency tip that you go to your policies and procedures and you look at them and you write that the definition of your 30-day time frame is going to be starting when the loan gets submitted to processing with the majority of the documents provided by the findings in the borrower. That will buy you a lot of extra time with which to not have to stop your assembly line and move a file up front because the 30-day time frame is coming into play and creates an inefficiency. So from our standpoint, this is another example of how compliance may tell you one thing, but if you look at the law and you look at the definition and you understand it, you're able to actually apply it and make it work in a very efficient manner. So that's efficiency tip 1, which you might want to ask amongst your team how they handle the 30-day time frame. So now let's go to outsourcing case 2, lost talent. We had a larger credit union that lost some mortgage talent for whatever reasons, retirement, or they were recruited to another bank or a credit union, being paid more. And they went out and they tried to recruit and bring in new talent. And no matter how hard they tried, they were unsuccessful in finding experienced people to replace them. So they were having to raise their interest rates to slow down volume. And they actually had originators that they had 4 originators at their credit union that some were paid somewhat of a salary and commission. So they weren't very happy that they had raised their rates. So they needed a solution. So what was that solution? Well, they reached out to us and they saw that the Silver program would work well from them. So the credit union could originate the loans. Their originators could still be as busy as they want to be. They could put their rates competitive. And then we could handle all the back shop for them as far as disclosing, processing, underwriting, and closing. Not to mention that we also took over the QC and removed those costs. And they were able to take some of the revenue that we generated for them on increased volume and actually hire additional salespeople to be able to originate more mortgages. We have sort of an example down below, an actual of they didn't use us because we weren't doing this in 2019, so we didn't fulfill any loans. And last year they signed up with us mid-year. We did about 110 of their loans, and then through the first 6 months of this year, we've done about 260 of their loans, and $60 million worth of volume. So it's worked out very well for them, and their team is very happy with the volume. So now let's go to efficiency tip number 2. What I would ask at your credit union is do you gross fund loans at closing, or do you net fund loans at closing? And what's the difference? Well, what I have found is that most credit unions are gross funding loans at closing, and the industry is net funding loans at closing. So what does that mean? Gross funding means that if a borrower is looking for a $200,000 mortgage, the credit union is wiring $200,000 to the actual attorney or to the title company. The borrower comes into the closing with their fees and their escrows, and the attorney ends up with money that's due back to the credit union. So they send them a check back a day or 2 or 3 or a week later with those funds. So the credit union had $200,000 outstanding, and that they got money back. So they really didn't really need to fund all $200,000. So if you do net funding, which I would say to you, you should ask in your own department if why you aren't doing net funding. We do net funding, and anybody that comes and works with us, we teach you or show you how to do net funding. Not that it's that complicated, but we just have to make sure that you're aware of it. And what we do is we calculate what costs are going to be brought by the borrower or the member to the closing, and we net that out of the gross proceeds that we would be sending the attorney. So if in that example, if it was a $200,000 mortgage and the borrower was bringing in $10,000 worth of escrows and fees, we would only send $190,000 to the closing, and the $10,000 that the borrower brought in would make up that difference. We would then put the appropriate money in their escrows and things along that nature on our side, and there's no money that changes hands back and forth. Much more efficient and much more revenue positive type of efficiency. So if you're not doing net funding, I would suggest that you talk about it, and if you use us, we'll make sure that you do use net funding. Okay, outsourcing, case study number 3, variable cost strategy. We had a mid-sized credit union that wanted to move away from having a fixed cost and invest more in originators and other items. And they didn't like what I would call the roller coaster of our industry. And mortgage banking is a roller coaster. There's great years and there's lean years. There's great years and there's lean years. So if you invest for the great years, especially in HR and talent, you're going to have those fixed costs hanging around after it goes down into a lean year. So this credit union said, let's talk about outsourcing and making this more of a variable factor for our cost rather than a fixed cost. When we were talking to them, we knew that our capacity needed to increase, and they actually had 2 people that were in the mortgage division that if they were able to move them over to us, they cut that HR cost. We needed additional talent to handle the additional capacity that was coming over. So it was a great move for both sides, where they reduced their fixed cost. We picked up their talent. Their talent happened to be experienced mortgage people. So it was a great win for both sides. And that same thing could work with anyone on the call. If you were trying to reduce costs and you had a certain amount of volume that was going to increase that we needed to increase our capacity, we can all talk about, looking at seeing how we can accomplish that. The credit union went over and we picked up their licensing of Encompass. They got rid of $30,000 a year in their Encompass licensing costs. Plus, they were spending a lot of money with hiring out consultants to help improve the software and enhance it to be able to do business rules and things along that nature. They got rid of all that. That's all done by us. Yet they still have full access to the system to be able to see loans, get reports. They didn't lose any of the visibility that they needed. They also wanted to have a new online website. So we upgraded that for them with a Consumer Connect website where people can go on and click on the loan officer they want, and it's all private labeled in their name. And loan applications come right into the system and make life very, very easy. And then as an example, in another case study, they took some of the additional savings and added another originator to their team. So it's worked out very, very well for them. So let's go to efficiency tip number 3. A question I would ask within your credit union is, are Saturdays a business day for your LE and your change of circumstance? And what I mean by that is if you take a conservative approach and you say, well, we're open for deposits on Saturday, and some other activities, but we're not fully open, but we're going to count it as a Saturday. You can do that, but that's a very conservative approach. We look at this and say, how do you make it so that it works best for you and your efficiency? You'll see that the definition of having to use Saturday as a business day for the LE and for the COC says you have to be open substantially for all your business functions, including the availability of personnel to make loan disbursements. And my guess would be there is no one on a Saturday around in any of your operations to make loan disbursements. So you meet the criteria of not having to count Saturdays as a business days for the LE or the COC. And you gain a minimum of valuable day in order to meet your 3-day disclosure requirements. And why is that important? A quick example would be is if somebody came in to apply on a Wednesday today, you have 3 days after the date of application in order to get out the LE. So that would mean you would have Thursday, Friday, and you would have to get it out by Saturday if you counted Saturday. But if you didn't count Saturday, you would have Thursday, Friday, Monday. You wouldn't have to get it out until Monday. So if your people weren't working on the Saturday, you would technically have only 2 days to get that out. So if you use this as in your policies and procedures as far as how you count for your LE and COC, you would gain additional days, a minimum of a day, and sometimes over a week and a few days for meeting and staying in compliance with your 3-day LE or COC. All right, case study number 4. We have some credit unions that have people that come in with self-employed and complicated tax returns, and it's very difficult to figure out what income to use. Not only is it difficult to figure out, it's very time-consuming with which to determine which income to use. I can guarantee you that if you're still doing this manually and you have underwriters that are looking at a loan and one is with tax return and one is without, they're going to grab the one without first and every time. So what we have done is we have a vendor called LoanBeam where we're licensed with them. That's fully integrated with our software, and LoanBeam uses optical character recognition to read every line of a tax return. So what we do is the tax return is put into a digital format. It's uploaded into this software. It reads it. It determines if, in fact, every page of the tax return is there or every schedule is there. It tells you if those schedule or pages are missing. Once it has everything, it will come out with either a income based on Fannie Mae or Freddie Mac's calculation. And how accurate is it? Well, Fannie and Freddie rep and warrant that if you use the numbers that LoanBeam produce, that they will never make you have a buyback based on income. So it's a great software, and at a minimum, if you guys wanted to sign up with us just to use us for this type of operation to make it so your staff has more time to work on other loans, we can do that and take that headache away from you. And as I say, rep and warrant that the income is accurate and correct. All right, efficiency tip number 4. Another thing to ask at your compliance and credit union is I see a lot of credit unions using 2 different right of rescissions or right to cancels. One's called the H8, which is a general one, and one is called an H9, which is specific. The H9 is specific, meaning that when you are refinancing someone, you give them the right to cancel. That's based on refinancing your own funds. So the borrower or the member currently had funds with you that you're refinancing. What we have found and what we have seen throughout the industry is the industry really just uses one form, the H8 general one. So they don't have to worry about making sure they have the H8 for certain transactions, the H9 for others. And why is that important? Well, it's important because if you use the wrong one, the H9 right to cancel form on a loan where it happened to be another lender's funds, not your own, by mistake, by law, the right of rescission would change from 3 days to 3 years. So why risk that? So we recommend, and the industry does, use the H8 form for all refinance transactions. So for those of you in the compliance side saying, well, you can't do that. Well, we actually have and can provide for you the Massachusetts case law that has ruled that the H8 works in either case. And we've had it verified by compliance consultants. So here's another area where you can push back against some audit that finds you having to use 2 different forms. We can help improve your efficiency by showing that you really don't. And not to mention, we take out of the error out of having a rescission go from 3 days to 3 years. All right, the last case study is go digital, paperless. We have one credit union just coming over to us that said, we do everything paper right now, and we've never had the impetus to sort of move towards digital. And by signing up with us, they have to go digital. We do everything with them digitally. So they're going to learn and see how well this paperless platform works. So we will have them take the loan, and it will be all digital. It will come to us digitally. It will be the member will be asked if they want to e-sign. If they don't want to e-sign, we will send them paper, but after they get paper back to us, we will convert it to a digital status and keep it so that your filing cabinets don't need you don't need any extra space in your filing cabinets. And after the loan closes, everything will be sent back digitally to that credit union. A copy, the actual note and mortgage, it's wet signed, will be the only paper thing that they'll get, but they'll get a copy of that along with all the other forms digitally to be able to move into what I would call the reality of going paperless. Last thing, efficiency tips, technology upgrades. What we find is that a lot of credit unions have people that do multiple tasks, not necessarily specialists. And so they, anytime there needs to be an improvement, nobody seems to have the time with which to focus on getting that improvement done for their system. So when you come to a fulfillment company like us that specializes in it, we set everything up on automation. We have system rules, business rules, everything in place that eliminates a lot of the clerical errors that could occur in the process for not checking this or not checking that. It provides us with hard stops and things along that nature that you can't move forward until certain things are done. And whatever our software doesn't have, we are able to purchase what they call plugins or third-party vendor items to improve certain things. Let's say you wanted to make a change to a template within your system. Well, these plugins can then go and anything that's in your system, change it automatically without everybody having to go in manually and do that on every single one. You can send emails to anybody in and outside the system. You can also have text messaging that goes to borrowers rather than emails, things along that nature, and stay in touch with really the way that the member wants to communicate and deal with you.
Jeff, I know you're wrapping up, but there was a question that just came in. How do you handle a notary signer with everything electronic?
The notary right now is still sort of a what I will call not necessarily a great accepted a way to do business in Massachusetts right now, even though it has the laws were changed to allow it. They're really not doing that on a first mortgage level as a general rule. They're doing that more on a home equity type of environment. So I would tell you from our standpoint, we're not allowing yet a notary closing on the first mortgage business.
Okay.
So finishing up with my last slide here, remote work capabilities, that technology to be able to have people, maybe a snow day or something along that nature, rather than they can't come into the office and the work doesn't get done, they can still work from home and move things forward. E-signing, e-document delivery. If people want to upload information, they can, and secure websites. Still get you all the views that you need to see of what's going on from reporting and dashboards and things along that nature. We have, as we say, private label online applications that we can do for you to make sure that your member has an easy way with which to apply. And then all of the services that we deal with are all what I'll call virtual. Everything is ordered online with just clicks of buttons, including mortgage insurance, appraisal, and we even get fraud reports and things along that nature to make sure that everything is aligned before that loan closes. So I think I'll wrap up. I think that wraps me up on my talk, and I'll stop there.
So great, Jack and Jeff, we're going to roll right into questions. We have a few that came in just to keep everything moving. This is about pricing flexibility. You mentioned that your pricing engine, but credit unions like to offer low rates to members. So can you explain how a credit union can influence pricing with partners' different metal levels?
Sure. What happens is using a pricing engine does not mean you make your price uncompetitive. We would sit with you and we would understand how you wanted to price your loans. And once you tell us how you want to price, if you want to price without loan level pricing adjusters or whatever it may be, we would work with you and we would use that within the pricing engine. The benefit of the pricing engine is it combines price with product. So it tells you that if you wanted to give somebody this good price, but you wanted it to have only for FICO scores that were 680 or higher, then it would make sure that there was a stop if the person that came in that was applying had a credit score of 620. So it helps make sure that you price your risk accordingly based on how you want to price it at your credit union institution. It does not elevate your pricing by using us or the pricing engine.
Okay, the next question for Jeff or Jack. If we were interested in the Silver program, what steps are necessary to sign up and how long does it take?
Sure. The Silver program, at any level that we have, bronze, silver, or gold, Once you tell us you're interested, you would work with Jack to get a contract signed. And then I would, during that, I would send over what they call a pre-onboarding worksheet. A pre-onboarding worksheet is where you fill in all the information we're looking that we need in order to set up the system. The key contacts, your HMDA numbers, your DU or LP numbers, all those sort of things that we would get in advance. We tell people that assume a 30 to 60 day time frame for that. Most of that is doing the testing. Once we set it up, then we want to test it and have you, the credit union, sign off on the testing. Are the fees looking right on the LE? Are they in the right spots that you want them? Does the name show as you want? Are the right forms in there that you wanted in there? Is it your lock, your lock agreement correct? All those sort of things. So I would tell you, 30 to 60 days is the typical time frame for signing up for the Silver program.
One of the questions, could you share a sample credit union branded website for member application?
Sure. I mean, like right now on this site, I don't know how to do it on the webinar, but we could have them go to Holyoke Credit Union's website and click on Holyoke Credit Union and apply online, and that would be one that we did for them.
Okay, that's great. And I jotted down the name of that person so we can, you can follow up as well. If a credit union utilizes Credit Plus for credit pulls and or flood determination, does MSIC Partners utilize the credit union's account access?
The answer to that is whatever the credit union uses for their credit, we follow up and use the same one. What they do is they give us access. They would contact Credit Plus or whoever their credit vendor is, and they would add us as a generic sign-on with their credit vendor. And then when we run it through the automated underwriting engines like DU or LP, we have to put those credentials in so that it then doesn't re-pull a credit report. It uses the credit report that they used when they were making their origination submission. So yes, we use that. In reference to flood cert, the flood cert, we tend to use one that we already have a vendor with, but if it, based on, we have multiple vendors, so it probably could match who they're using too.
Price adjustments based on credit score can be a source of concern among some board members. Can the engine be programmed to ignore credit score price adjustments and look at all the others? Yes.
If you're using a pricing engine, you can configure it however you want. As much as finite as you want. You can get rid of any credit score adjuster. You can get rid of any loan to value adjuster. You can apply it just to one product. You could just put it to your 20-year fixed or your 15-year fixed, or you could take it off of your 15. You can do it that granular. So yes, you can do that in any format you want, or you can have it where you just don't have any credit score hits at all.
Can MSIC Partners now offer FHA or mass housing loan options?
Right now, we do offer the mass housing option and the mass housing option with down payment assistance if we can fulfill those. FHA is in the works. That's a 2022 opportunity for us to use that.
Okay, and once we sign up, can we switch between the three levels? And how long would that take if we wanted to move from silver to gold, for example?
Yes, you can switch between levels, and you can actually use two levels at the same time. Let's say you wanted to just send some loans for us to do our bronze level underwriting only. That's fine, and you had other loans you wanted us to do the whole silver level. Yes, we can do that. Switching over from one to another, I would say is a 2-week process or less, because once we've programmed everything for the silver, the gold level, it's the same information pretty much all throughout the system.
Okay, does anyone else have any other questions? If you do, you can just throw them right in the Q&A box and we're happy to answer them. And if not, you do, Jack and Jeff's contact information is on the screen. Everyone today will be provided a copy of the PowerPoint presentation, and then a recording of this webinar will be made available on our YouTube channel, as well as our website. So I will let everyone, all the attendees today, know when that's available. And obviously, if you have any other questions that can come up, you can reach out to Jeff or Jack or Mike or myself, and we'll get right back to you. Jeff and Jack, thanks so much for today. You know, great presentation. I just wanted to let everyone know to please mark your calendars. I'll give you the schedule for MSIC's webinars till the end of the year and into 2022. Next month on October 20th, we're going to have a board succession training by Stan Regalewski of K&L Gates. Then in November on the 10th, we're going to have an end of year economic update and presentation, also a webinar, and that will be by Professor Mike Goodman. In January, on the 28th, which is a Friday, MSIC is going to hold its 60th annual meeting of members via WebEx, so please do plan to join us then. And then in June of 2022, from the 27th through the 29th, MSIC is going to be holding its first in-person event in over 2 years. It's the MSIC Member Summit and 60th Anniversary Celebration, which will be held at the Mount Washington Hotel in Bretton Woods, New Hampshire. The focus is going to be on collective action, but also celebrating 60 years of MSIC and the strength and resilience of the cooperative. It's going to be a world-class event, a lot of fun, so I hope you'll mark that on your calendars. The save the dates will be going out next week, and then there'll be more information to follow. I'll be sending out information for all of these events, but I just wanted to give you a chance to jot down the dates, get them on your calendars, and join us when the time comes. And that's it. Thank you all for joining us today. It was a great turnout. And again, Jeff and Jack, thanks so much for MSIC Partners and their presentation.
Thank you.
Take care, everyone.